new, new equipment, and of course, new wages, all of which generate new sales tax revenue. We measure all of that. Every project goes through our impact analysis tool. Many of you are familiar with that. If not all of you are familiar with that, you've seen some of those reports before. What happened is when the county gave us that charge back in 2017 and it got implemented starting at the end of 2018, so 18 is kind of that benchmark, we looked at what was the difference and how that flywheel was moving and what those impacts were. A 73% increase. That's crazy in the amount of CapEx that occurred based on the redesign of that impact fund and the deployment of those dollars into our economy. When it came to new payroll, literally we take every job that is created through that, run it through our analysis tools to add that payroll together. And when we do, so basically doubling the kind of payroll increases and impact that we were having previous to that change of the impact fund. And you can see the public benefits have gone up accordingly, 81% increase. I wish my retirement program was doing so well. Now, we modeled this way back in 2017 such that that revolving component, remember I said earlier, we want to keep doing that over and over. It's doing that. It's revolving. But some things have changed in the economy and in the market to the favor of Washington County. Let's take a look at what those are. Slide 4 or page 4 of your packet here. The typical loan size we had modeled at 300,000. That was based on historical. It was adjusted a little bit with the idea that this initiative and this fund would be successful, because again, it wasn't an incentive fund just for the purpose of providing corporate opportunities for growth. You wanted it to be an investment. So we had projected that to not only be the case, but we were conservative. Today, though, we're looking at average loan sizes that even since 2018, we're above that assumption of 300K to 475. The last year or two, we're now at over $1 million worth of our participation in order to support these projects, which have grown in scale. And you'll see that how big they've become. We also were looking at a loan term that was not quite 8 years in length. Today, because of the scale of the projects and the types of projects, many of them being real estate instead of equipment, they are now well over 10 years. In some cases, we've had a couple that are 20 years because we have to align, if they use SBA as part of their funding package, it's the Small Business Administration programming, we have to align with their 20-year horizon. So in some cases, we're out quite a ways. And lastly, we were looking at a fund utilization that would hover somewhere in the neighborhood of that 70% range. That's a healthy revolving fund. You want some headroom in the fund to be able to continue to do deals. You don't want to be bumping right up against your fund limits. And so we had projected that, but today we're at 80% utilization. So we're now inside of that headroom and getting kind of uncomfortable with what we're able to accomplish with that. I had alluded to earlier the project sizes changing. If you take a look at slide 5, that is in part due to the interest rate environment, which I'm confident none of us were predicting what those interest rates were going to do. COVID, of course, contributed to that. But even after COVID, we've seen these rates stay rather high. And what that does is two things. One, it's an inflationary indicator. And so project costs have gone up. You heard that in an earlier presentation. That it's not just in residential, that's in commercial development. But on top of that, financing costs have gone up. And that means that projects where they used to be about 1.5 million in size, today they are 10 million. And the last year or so, we've got $20+ million projects that are in front of us. And we'll talk a little bit more about that in closed session. Again, that is the total project size, not what we participate in. We don't participate in at that level, but that is an indication of the fact that we are dealing with much larger projects. This is all good news. This is a good thing to be happening. It's again an indicator of success of your efforts and our efforts to partner together in this tool and the use of the tool. Now we're going to take a look at that revolving component. That's if you look at page 6. Up until the last couple of years, we were pretty much at 1-to-1 revolution. That's what you want to see. That's that evergreen component. As investments were going out, money was coming back in, and we were able to continue to revolve it in a very comfortable way in order to take advantage of the moment and time that we're in. And that's also something to remember. And we certainly remember that every day. The current economic environment doesn't have to be that way tomorrow or a month from now, or certainly 2 years from now. So when we've got an opportunity, we go. We don't keep powder in the keg dry. If there's an opportunity, it's qualified, and we can structure the deal well, we go, we win it. And that's the name of the game. So now we're at we're deploying resources at a faster rate than they're coming in, 3 times at this point, at the rate that the funds are revolving for some of the reasons that we had mentioned. And we'll get into more detail into this in closed session, because obviously we're talking specific projects at that point with proprietary, some of them have not been decided, but we're going to do something unusual, which is open that hood up a little bit and show you what's underneath the hood. And we need to do that because there really is a policy decision here. We can continue to operate the way we're operating and essentially hit that limit. And that sets the ceiling on our ability to participate and leverage the moment, or through some policy considerations that staff will be talking about. There's an opportunity to leverage this moment in time and continue to accelerate and see that economic growth, not just be successful, but do so in a way that leads the way here in Southeast Wisconsin. So that's really the choice in front of us. That's your last slide. Slide 7, backing up 1 slide, is simply an indicator of what our current pipeline is showing. And essentially, we've got a bit of a cash gap if our higher confidence deals move through that we need to deal with. So we're going to be making that upper limit choice very soon. Those numbers are already old, and I have in the closed session packet some new information for you that I'll be happy to share. The gap has grown actually, which is good news in some respects.
Are there any questions before we proceed? Well, then I'd entertain a motion to go to closed session. Obviously, there are some big investment things and we need to keep this type of thing confidential. So that's our reason for going to closed session. So motion to go to closed session, Supervisor Kelling, second by Supervisor Shadron. We'll do a roll call vote. In favor?
Aye.
Aye. Okay,